market's driven by greed and fear. Warren Buffett says it all the time. Be greedy when others are fearful and fearful when others are greedy. In the absence of knowing how much enough is, more is always better. So if you have $5 million in the bank today, and you don't know that's enough, you want more, you want 6, you want 7, you want 8.
We have been talked down by administration at the hospital for years, making it sound like we can't fucking add or subtract. It's so complex. You guys don't understand money. Well, you and your administration. I may not understand what 75 basis point is, but if you tell me, dude, it's 0.75, I'm like, okay, I know what that means. Sometimes it's just the lingo.
It's my job to come in and then say, hey, I'm your financial doctor. I'm going to make sure that your financial health is on point and survives.
I open my Chase bank account and I look at my bank account and I'm like, that could go away tomorrow.
100%.
Like it's sitting in somebody's database and it's a matter of Russian intelligence just hacking and going like, let's take all this guy's $5,000 that he's made all his life and go.
You're like girl bossing so hard that Putin wants to take you out.
Two vascular surgeons walk into a bar and come out with a podcast. We are talking everything vascular and not. Welcome to the Life of Flow podcast.
The following podcast is not relating to my teachings and work at Del Cedar Medical Center and is for entertainment purposes only.
Hello, everyone. Welcome to another episode of the Life of Flow podcast. And today we have an episode that God knows I need. We have Frank Ross, Vice President and Wealth Advisor at Pentangle Wealth. Frank has extensive experience working at JPMorgan and Oppenheimer Funds and is a financial advisor and helps people like us be good stewards of the wealth that we make for ourselves and for our families. So we had a great discussion, lots of questions, basically free consulting for me and Miguel, which we desperately need in this field. So I hope you guys enjoy and find some value too. Vamos.
All right, Senior Frank, welcome to the Life of Flow, dude. It is awesome to have you here. Frank's a good friend. Frank's a neighbor. I could throw a ball over to his backyard. Also part of the Hope family.
I like your new neighborhood.
It's awesome.
It's nice.
It's nice. It's really nice out
it's like
there.
Family, like homey.
Yeah,
I like it.
Yes.
Yeah.
It's very zen.
Yeah, I like this.
There's a lot of water.
I like this for you more than the other one.
Yeah. No. Here's the deal. When I've always been city boy, and then Jenna came from the suburbs into the city life. And I will tell you this, I had to fight her more than myself in this change.
Really?
Mm-hmm. And she was like, I'm not going to the burbs again. Like, that's just not going to happen.
Yeah.
One day in that house, and she looked at me, she's like, we were missing out.
Now you're a family man. Now you're like a bird man. You come in, you have your manicured lawn.
But listen, it's also smart money. I came from a 1,200 square foot not dump. It was a beautiful starter house.
Yeah.
That's on the market for $670 something right now. And this house was on the market for $670 something a year ago. And it's 20 times the size of the other one with a pool
and nicer
and all the commodities you need in life. So we'll probably get to that. Frank, you're financial advisor, wealth management. Yes. I guess that's your title. That's your given title.
Yep. Wealth advisor. Yeah.
And, we'll go into the details, but you've been through all the big names. I mean, when I started researching, you meet people, you never really go into their background.
Yeah.
And then you start, I friended you on LinkedIn and I started digging into what your past has been. And man, you've had some pretty big ass fucking jobs in legacy companies of management and money management. I maybe to understand you as a person, let's go back in time. Take me back to when you thought, I want to get involved in management of money or finances, or how was that moment? What was your aha moment getting into that service line of money management?
I have an interesting background. I grew up relatively lower income earning family in the Northeast up in Pennsylvania. And, it was a coal country town. People didn't make a lot of money back there. And I always had these wants and desires. I wanted nice things, and my parents couldn't afford to buy them for me. They just didn't have the income to do that. So I started working at a very early age. I started working at 10 years old. I got my first real job at 14, where I was actually paying taxes and, earning an income, getting a paycheck, and then doing things on the side. And I don't know if you guys remember, but back then banks were only open from like 10 a.m. until 2 p.m. and there was no ATM machines or anything like that. So if I had a chance to get to the bank to cash a check, I was just getting cash, right? And I remember it was my senior year in high school. I was talking to one of my teachers and I kind of dropped that I had like $5,000 sitting in my sock drawer. And back then that was a lot of money, right? Like,
Yeah.
$5,000 for an 18-year-old kid in like 1993, like that's a boatload of money. And he was like, you need to start investing your money. So he got me this book on investments. And I opened my first mutual fund at 18 years old. And I was going through college. And I'm like, wow, like my money's making money. Like this is pretty cool. Like my money has a job too, right? And I got into finance in college, and I was like, you know what? I had a knack. Like when I started college, I actually wanted to be a secondary and history teacher. I love history too. And I've always had that passion for coaching and teaching and things like that. And I imagine you guys are like this too, but I think everybody has something that they just see and they get, right? And I've always been able to just see the markets and the economy, and I get it. And not only do I get it, but then I can simplify it when I explain it to people so that they understand it. So I was like, man, I really want to get into this industry and I really want to help people. I mean, that was always my goal. And, still to this day, me making money off of my clients is a byproduct of what I do. I do the right thing for them and I help them retire and save and, send their kids to college or buy houses or whatever it is. And, by me doing the right thing for them, that's how I earn my money. And, when I started out, I started as a financial advisor back in, this was the spring of 1998, right out of college. And back then, everybody was in our industry a stockbroker, right? If you were, you had money at the bank and you wanted to make more, right? You had a CD or a savings account, and you're like, wow, that's not earning me enough money. Well, I'm going to go to a stockbroker and they're going to invest my money for me and make more. And when I started out at 22 years old, I looked like I was 12, right? I go back and I look at pictures and I'm like, man, I can't believe it. Like this like baby right out of college, like anybody would give me their money. And it was a difficult game, right? Like I was walking into clients or, prospects' houses, people that I knew, right? Like I had a landscaping business when I was in high school and college. And I was going back to these people and say, hey, when I'm a financial advisor and here's what I do. And I was, doing more than just investments. I was doing life insurance and long-term care and all of these other things too. And those were easy because those were a product. And if a client needed it, I had that, right? But when it came to managing their money, I would have people say, oh, well, Frank, yeah, I've had a Merrill Lynch advisor for the last 20 years or, Morgan Stanley or whatever it is. And my advisors in their 50s and, they've been doing this for 30 years. How are you going to beat them? And there was no answer to that, right? I was never going to build a better portfolio than somebody that had 20, 30 years of experience.
Well, plus 4
So
years ago, you were cutting their grass.
yeah, exactly, right? And I look like I'm a child, right? Like,
Yeah.
how are you going to do this? So, the funny thing is that I got into financial planning back in the late 90s. And, that's so customary today. If you're working with a financial advisor, 99% of the time you're going to have a financial plan, but nobody was doing that back then. And like I said earlier, people were going to a financial advisor because they wanted more, right? They wanted more money or more returns, right? They were getting 5% at the bank and they wanted 8 or 9, right? And what happens with a financial plan is, and I really, when I was doing this back in 98, it was very unique and different, but I wasn't concerned about more. What I was concerned about is enough, right? How much money is enough to let you retire at 60 years old and never run out? How much is enough to send your kids to college? How much is enough to buy that dream house or that beach house? And I came up with this sentence back then, but it's in the absence of knowing how much enough is, more is always better, right? So if you have $5 million in the bank today and you don't know that's enough, what do you want? You want more. You want 6, you want 7, you want 8, right? If you're getting 6% return on your money and you don't know that's enough, what do you want? You want more, right? I want 7, 8, 9, 10% returns. But if I can tell you that $5 million is enough to retire, if I can get you 5 million at 6% return, and you're retired at 55 and you want to live off of $300,000 a year for the rest of your life, and I can build a plan that does that, then why are you trying to get more, right? We're just trying to get you enough and figure those numbers out. And that was really revolutionary back then, but now it's pretty much customary. You have to have that if you're doing this job today.
So what was your time like in these big firms, and how was it that you got to a point where that was just not fun, or maybe you didn't agree with it? Tell me what led to that breakup.
Yeah, so that's a great question. So I started as an advisor, and it's a long story, but I ended up moving from Pennsylvania to Hawaii, and then Hawaii to Georgia, and then Georgia to Texas. And I started out 3 practices, and you guys know this, right? Like, if you have a practice in an area, and you have clients in an area, and you pick up and move halfway across the country, those clients aren't following you, right? Especially back then, right? So when I moved to Texas, I was like, you know what? I'm not going to start another practice. So I ended up going to those big investment firms like JPMorgan, Oppenheimer Funds, and places like that. And basically what I was doing was I was advising financial advisors, right? So I'm kind of like the liaison to that company. So my clients were actually financial advisors. I would go to their offices. I would bring them kind of our outlook on the markets and the economy, help educate them so they don't have, kind of like you guys too, like you have pharmaceutical reps and product reps and things like that come in and say, hey, you don't have to do the research on how this product works. I'm going to bring it to you. Right.
Oh,
So,
okay.
yeah. And then,
So you
I'm
didn't
kind of that
actually
liaison.
work for these companies. You would offer services to their
Well,
advisors.
so I was
Hmm.
working for like a JP Morgan, for example, but then I would go to a Morgan Stanley or Merrill Lynch financial advisor, give them our market and outlook and
Got it. Okay.
economic outlook, things like that. And then if they used our investment solutions, our mutual funds or ETFs or anything like that with their clients, then I got paid off of that.
Got it. Okay.
And that became, and I think back in the day when information was hard to get, right, before the internet was really up and running, we were essential, right? Like, we were that resource. Now information is so easy to get. You can pop up a podcast, you can, go to ChatGPT, you can go and get information in a lot of different places, where it's not as, it's much more accessible now than it was back then. But what happened then too was I was doing that for years and years and years, and I'm really working for somebody else. I'm really building that wealth for somebody else, and had nothing that was my own, right? And at the end of the day, every month was starting over, right? I was a commission-based person, and at the started the year is like, I have no idea how much I'm going to make this year, right? You have a great month, but you never know what the next month's going to bring. And I wanted to build something that was mine. And at the time, I guess I met my business partner, Gene, back in 2015, and we became really good friends. He was one of my best clients. And for years, he was like, Frank, come over to my practice. I really want you to join you. We have the same kind of mindset and outlook. And back in right at the end of 2022, he broke away and went off by himself. And he told me, he was like, hey man, I really want to build this practice the right way. I can manage what I have right now by myself, but if I want to grow, I need to bring in somebody. And I was like, you know what? I really believe in how we do our job and how we run our practice. And I was like, man, I'm on board. So I'm loving it. I absolutely love what I'm doing right now.
And this is Pentangle, right?
Yeah, Pentangle Wealth. Yeah.
So
And that was really, go ahead.
what year was it that you guys built it?
So I guess Dean started his practice back in 96, and it's had
Okay.
a couple different names, but it's been basically his practice since then. And most recently was Global Wealth Advisors. And then he broke away from that group and went by himself. And the Pentangle part that comes from, he's a Marine. And if you ever talk to a Marine, he might be out of the Marines, but he's still a Marine, right? So there's
Right.
no former Marines, right?
Once a Marine, always a Marine. Yeah.
Yeah. And there's some core values that, when you're in the military. And he's like, you know what, we want to bring these core values to our clients, like the honesty, integrity, all that kind of stuff. And that's really where that came about. And I was like, man, I'm on board. And the cool thing about it is when you're forming a team, right? And let's use a football team, for example. And I've used this example a lot, but if you look at probably the greatest dynasty of a football team ever, you look at the Patriots, right? And imagine having 12 or 11 Tom Brady's on the Patriots. How good of a team that would be. And at first it sounds great,
It would suck.
but then yeah, they suck, right? He can't catch, he can't run, he can't block. You only want one Tom Brady. And that's how me and Dean are, where he does certain things and I do certain things. Like I build all the financial plans, I build the portfolios. I'm really kind of structuring out for a client, bringing them in and saying, hey, what do we want to accomplish here? What are we trying to do? And then building that out for them. He's the rainmaker. He goes out and meets the clients. He's bringing them in. He's working on the practice and running it and running the business side of it. So very rarely do our clients ever meet with both of us at the same time. If you're meeting, if you have a meeting and you're wanting to, construct your plan and figure out what we want to do, that's me, right? That's my job. So it's, we do a lot of stuff joint together in the beginning, just as we're bringing the client in, depending on how big they are. But then after that point on, you're probably only going to see one of us throughout the time.
Frank, let me build you a picture. 32, 35-year-old physician, male, female, was making $70,000, and then the next month making $375, $350. And in 7 years, they're going to be making $650 if they're smart. Walk them through, what their potential is, and, give them a plan. Like, hypothetical person, this is what you're doing. This is how we're transitioning. This is how we're moving. This is your outcome.
I think when you look at that situation, most people I want to retire at a certain age, right? I want an income stream. And you get these high earning individuals, and like, I'll tell you, our specialty, and it's not all we work with, but a big portion of our clients are refinery workers, right? So very similar income streams. These people are coming out of training making $100,000 a year. They're in their mid 30s, 40s, making 200, 250, somewhere in that range, and very high income earners. But then they want to retire early too, right? So you want to retire in their mid to late 50s. You don't want to work forever. But to retain that income stream, right? I want to keep, you think about it, if you're making 300, 400, 500 grand a year, you're living a nice lifestyle, right? You're saving money, but you have a very nice car or multiple cars. You have a very nice house. You have a family. You have expenses that are going out that are never going to end. You still have your tax bill. You probably still have a mortgage. You still have all those different things. So it's replacing that income, I think, becomes that most important goal. And for most people, if you retire in your late 50s to early 60s, and you're going to live until 85, somewhere in that range, you're going to need $8-9 million saved up to do that. So for each person, what I think I do is I figure out, like you say, like, oh, okay, I'm 35 years old right now. Okay, when do we want to retire? Right? So let's say 55, for example. I sit down with them today and say, okay, how much wealth do we need to accumulate between now and then? What's your number to get to that's going to then allow you to replace that income stream when you stop working and allow you to continue to live that lifestyle that you want to live for the rest of your life without the risk of running out of money.
Can you give us a little nuts and bolts on what that looks like a little bit without giving all the trade secrets away?
Oh yeah, sure. Yeah. So, I mean, we use some pretty complex financial planning software. So have you ever heard of Monte Carlo based simulations? So I guarantee you've seen it, right? So what a Monte Carlo based simulation is, it's running maybe 5,000, 10,000 different data points of things that could possibly happen in the future.
It's like game theory?
Kind of like game theory, right? Where you see it all the time, and you're going to probably see it and if not pretty soon, is when a hurricane comes, right? And you have that cone of uncertainty. But have you ever, I don't know if you've ever seen it, they'll say, oh, well, the European model's running the hurricane here and the American model's here and this model. Well, it's all those models running together, and then they kind of average them out, and that gives you your cone of uncertainty. So what we're doing is we're running 10,000 different possible future forward market scenarios that could possibly happen into the future, and saying, okay, here's where you're starting today. Let's say you're starting with $800,000 when you walk in the door, and you say, okay, I'm 35. I want to retire at 55. How much wealth do we need to accumulate during that time period? And it'll tell you, hey, you have to save, $20,000 a month to get to that level. And then you say, okay, and based off of a specific return too. So let's say you're getting 7% return on your money. Well, now I got to build a portfolio that's going to give you the potential to earn that return with that amount of savings over that time period. And then also not only gives you that return potential, but it also fits into your risk tolerance as well. Because I'm a very conservative investor. I don't like when I see brackets around my money, or if it's in red or anything like that. I hate that. I hate seeing that. It's going to happen, right? The markets go up and down at all times. But then, so what we're doing is we're combining all of those things together. And then it's kind of like, I use a NASCAR analogy here. If you've ever watched NASCAR, or F1 or anything like that, if you painted all the cars the same color, you probably would be able to tell the difference, right? The Ferraris and the Mercedes, or the Toyota and the Ford and the GM cars, they all look very relatively similar. It's the engines, right? The engines that are driving that car. So I'm creating the engine that's going to work for the client as well. So it's a holistic plan for them.
I'll tell you a little bit of my experience, and you can tell me how wrong I am. When I started, and just with one particular aspect, I looked at my retirement plan, and when you come into one of these universities, they give you a retirement plan, and they give you a date, like whatever fund this date, and this is the day that you're like going to retire, like whatever. And then I start looking into it, and I'm like, man, this thing's like not doing that well compared to like whatever the market. And then somebody gives me this book, and it's like the little book of Common Sense Investment by something Vogel. And I read it, and I was like, interesting, cool. So, and you can tell me I'm probably wrong in this, but basically the premise is, a low fee index fund in the S&P 500 will outperform managed funds over an average. So I do that. I was like, call my Fidelity guys. Hey, bro, change this shit and just put it in the lowest fee S&P 500 index fund. And it's actually done pretty well compared. So how am I wrong? What am I missing? Because I know I'm missing something, obviously. I don't know shit. What am I missing with that?
So I would never tell you you're wrong, right?
Oh, you can tell me you're
My
wrong.
dad
I'm
used to
wrong all the
say,
time.
my
You should.
dad
He
used to say
needs
this all
more.
the time.
This guy
My dad,
this guy tells me I'm
He
wrong all the time.
needs
So
more people telling him that. This is the way that you cure egomaniacs. So feel free to be unfiltered.
yeah. So my dad had this basement filled with tools, and he used to always say there's the right tool for the right job, right? So you could take a screwdriver and turn it around and use the handle of that screwdriver to hammer a nail. But it's much easier to go grab a hammer, go walk across the room, grab the hammer, and then hammer it in with that. So there's no right or wrong investment option, because if there was the one best thing, everybody'd do it, right? So it's a combination of things. The best book that I ever read when it helped me with the investment industry is a book by Daniel Ariely. It's called Predictably Irrational. And what it is I don't know if you've ever heard of this, but we all know economics and finance. And like, for example, it would basic economics, you have a supply and demand curve. The more a supply you have, the more demand you have for a product, the higher the price is going to go, right? Because if your supply is limited and demand goes up, more people want to buy it, you can sell for more, right? So there's basic rules of thumb when it comes to whether the markets or the economy. What happens is human emotion takes place, and human emotion causes us to make mistakes. And we all have behavioral emotions inside of us. And there's ones that's a good example is what's called recency bias. And we're here in Houston. What's the temperature going to be tomorrow? It's going to be hot. It's going to be hot tomorrow and the next day and the next day because it's summertime. And we're going to wake up one day and say, oh, it's going to be hot tomorrow. And it's not going to be. It's going to be chillier, right? Because it's going to start getting September. But recency bias is whatever's happening right now is going to continue to happen. So if the markets are going up like they happen, we're hitting record numbers. In our mind, it says, well, the markets are going to continue to go up, right? But like think back to 2007 to 2009, when we had the Great Recession, markets are going down. So in our mind, the markets are going to continue to still go down. So what happens is you could put your money in an index fund, and you know what? If you just set it, forget it, and don't touch it, you're going to be fine. But what happens is people watch it and they look at it every day. And my industry is the only industry in the world that when prices go up, people want to buy, and when prices go down, people want to sell. It happens nowhere else, right? But we all know what do we buy and sell stocks? We buy low, sell high. But our mind tells us to do the opposite thing, right? So I have people coming in my office saying, Frank, I want to buy NVIDIA, or I want to buy Bitcoin at $110 or 110,000 a coin. And I'm like, we're buying at highs, right? But when the market drops, right, back in April, when we had the tariff situation happening and the markets were dropping, we have clients calling us saying, oh man, let's get out, right? Let's get out of the market. And having that one index fund and seeing the volatility of that one fund going up and down, a lot of clients can't handle that. So why we wouldn't do that is we invest them in a more diversified portfolio. So, if you're going to buy the S&P 500 index, which has done really, really well over the last, 2 decades or so, might not always be the best investment out there. Right. International is doing better this year. You'll have years that the markets are bad, fixed income, things like that. And we'll build a diversified portfolio where not everything's going up or down at the same time. In fact, like I always tell my clients, if you look at your portfolio and everything is green, that's probably not good, because when the environment changes, everything's likely to be red then too, right? So we want things counteracting and having what we call low correlation to each other, right? So they react a little bit differently. And it might not be good for you, right? You might like that index fund. You might be okay with the roller coaster ride where other clients can't be.
This is another random thought I have. Like, I think there are different types of games, right? There are win-win games and there are win-lose games. Probably theoretically it isn't. The stock market's probably it's human invention, human value being created, so it's probably a win-win game. But it seems like they're competing actors, and they want all the pie. So it seems like a win-lose game. But if it is a win-lose game, then I'm competing against JPMorgan, against Ray Dalio, all these guys that have I'm gonna lose. Is dollar cost average then your only strategy? Because there's no way you're competing against supercomputers at JPMorgan, right?
Right. And it's a smart thing to do. In fact, I do that with every client that walks in my door. I tell them we're going to dollar cost average into our portfolios, right? We're going to, you don't want to take the risk of buying at an all-time high or something like that. And now we do, I'm not a market timer, by any means, but we're also smart and look at trends. And I did get, when Trump got elected, we knew that was going to be a good thing for the market. He's returns were great, prior to COVID. But I also knew there was going to be a lot of volatility. And I knew that coming into, his second term without nothing to lose, that he was going to shake things up a little bit. So I got my clients significantly more conservative at the beginning of the year, right before inauguration. And then, and we saw that. We saw the markets run down with the whole tariff thing. But then, all these things, the dust is starting to settle. And as soon as Mr. Trump said, if I was my friends, I'd be telling them to invest right now, man, I turned that dial back up. And what we've seen is we sit, record highs in the market. But for most clients, they don't have the ability to do that, right? You're not sitting in front of your computer every day just watching that. In fact, I'm not either, right? I'm after this podcast, I have a bunch of calls with clients coming out after it. I'm not sitting on my laptop here making trades constantly all throughout the day. But yeah, like those guys are. right? Ray Dalio's sitting in front of his computer right now. He's got a whole team of him
he's
around,
not, but he has like a
by
10,000 people doing that.
yeah, exactly. Yeah,
Yeah,
he's not, but he's got
yeah,
those people are, yeah.
yeah.
And we can't, right? We don't have the access and the ability to do that, so we have to do it a little bit different. And we're not trying to compete against them. A lot of times we can ride with them.
Okay, so your perspective is that they're not trying to take everything from us at all times. That's my perspective on, like, BlackRock is like they want to take my paycheck at all times. Anyway, that's my own conspiracy brain.
No, I guess I was trying to also figure out, you and I have talked about this. There's a lot of people that follow us, and I assure you that the majority of them don't have financial planners or financial management companies. Is there ever a wrong time to reach out and say, hey, I need some time. I'm sorry, I need some help. Because I'm sure there's going to be the, mid residency dude that's at 70K, but there's also maybe the senior guy that's at 600K. So the question A is like, is there ever a wrong time to try to say, hey, I need some help with what I'm going to do next and how I'm going to organize this? And then 2, would you mind explaining what's the cost to work with an agency like yourself for those there that may not have somebody and that may say, hey, you know what, maybe I'm going to give Frank a call at the end of the show. So explain for those people that are not clients but are potential clients how it would work if there's a wrong time at any point in time.
Well, I'll start out by saying this. Every client that I've ever met with, everyone has always said, I wish I would have started earlier. But what I always tell them is, unfortunately, I don't have a time machine. And I don't think you do either, right? We can't go back in time. But all we can do is say, hey, where are we today and where do you want to be? And how can we develop a plan to get you there with the highest probability of success? But like I said, everybody wishes they would have done it earlier. So there's no to start out too early at all, right? If you have a positive income stream, the number one thing is it's kind of like building a house, right? We want to start out with a very solid foundation. So the first thing you want to do is when you're making money, right? You're graduating college and you've got your job and you're making an income stream, is we want emergency money, right? We want to have savings there just in case something happens. A tire blows out in your car, the water heater goes out. Crap, I need to go buy a new refrigerator. Something like that where I can go and have emergency cash on hand to make those products or buy those products. After that, right, once you have that emergency money, where the perfect place for that is the bank. You go there, you get a debit card, they give you a little bit of interest, and that's what that is for. After that point, where you have a $1 more than that, you should be talking to a financial advisor to say, okay, now what are the financial goals that I have? Maybe it's sending your kid to college. Maybe it's buying a second house or a dream house. Maybe it's for most people, the number one most expensive financial goal they're going to have is the retirement. Like I said earlier, a normal person's retirement, I don't say normal person, a high income earner, like you said, 150 to 500,000, per year, somewhere in that. Somebody's doing really, really well, but they're not the person making $10 million a year, the actors, the celebrities, or things like that. Those people are going to need between $5 and $10 million at retirement to live that lifestyle. That's a lot of wealth, right? It's not just going to happen. And I think what the biggest mistake people make is they keep putting it off. I do it with my health, right? I haven't gotten a checkup at the doctor's, like a normal, just physical, in years. I'm fine, right? I'm healthy. And you guys as doctors are probably sitting there going, Frank, you're crazy. You need to be doing this, right? Same thing as people think, well, I'm gonna wake up at age 60 and I'm just gonna have the wealth I need and get there. It's probably not gonna happen. Right? You got to plan for these different things. So there's never too early of a time to do it. It's so financially and fiscally smart to have a plan in place to get you there, right? If you were going to drive across the country, wouldn't you get your map out and say, what roads am I going to take? Where am I going to stop for gas? Where am I going to sleep? Where am I going to do all these things? Think of it. Your retirement's going to be 25, 30 years long. We need to plan for that ahead of time. The cost range, depending on what you do, back in the day, back in the late 90s, early 2000s, most people would buy like mutual funds and things like that, and they would have a fee associated with them, like a sales charge. So if you invested, I don't know, $500,000, they charge you 4 or 5% up front. They took that fee, the advisor got paid off that, and the rest got invested, and they made a small amount of money off of that for the rest. The advisor made a small amount of money off of that for the rest of the time. Most people today are doing what's called fee-based financial planning, and that's what we do. Is depending on how much you have with us, depends on the fee that we charge you to manage everything, right? Now that's just not managing your money. If you could do that, you go to Robinhood or you could go to Schwab or whatever it is, and for 15, 20 basis points, you could get a portfolio built for you. That's a portion of what we do, but it's full on wealth planning, right? It's building your financial plan. It's doing the insurance planning, the investment, the tax planning, all the different things that we do. We kind of range from 1.5% down to 75 basis points, depending on how much wealth you have. And we're on the same side of our table as our clients, right? That's a set fee that we're going to charge a client based off how much and assets they have with us. So we have a vested interest in that amount of money growing up, because the more money you have with us, the more money ultimately I make. So we're on the same side of the table now, right? And that fee, and that's like what separates us from some other advisors out there is we're purely independent. So even though we're Pentangle Wealth and it's me and Dean Elliott that are business partners and it's our practice, we clear through a firm called LPL Financial, which is the largest independent financial advisory firm in the United States. More financial advisors than even Merrill Lynch has. But we have them as our backing, right? They do our compliance, they do our paperwork, they send you your statements. You go onto the website and you can see your portfolios, things like that. But the independence is we can do whatever we want for you. And I'm going to charge you the same fee regardless. I'm not going to get paid more if I use a specific product. Ooh, if I use this, I get paid a little bit more. No, I charge you, let's say I'm charging you 1%. I'm getting that regardless of what I do with you. So I think that's really important as well, is that your advisor's working with you, not against you there too.
Well, I also think that the better I perform, the better you perform.
Yeah.
Right. I mean, it doesn't, I think it's important for the listeners to understand that it's not a ton of money at the end of the day. I mean, it's something, but it's a small amount. I mean, it's a fraction of your wealth that they're taking to manage your wealth smartly when we're busy doing other stuff. But at the same time, that the better you do, the better they do. So that, it's kind of like, why wouldn't you? It's almost like an investment.
But I think a lot of people could say that in a very ambiguous way without the fiduciary responsibility of, So I want to dive into that. So what would be the difference in philosophy or approach between, say, somebody working for Merrill Lynch and somebody that's independent?
Yeah. Why should I go to you instead of just calling Merrill Lynch and saying, hey, manage my fund?
Yeah. So you're going to get very similar things, right? And believe me, when those advisors were my clients, they're good too, right? Everybody's good. It's really finding somebody that you can relate to and trust and understand. And really for us, and I'll tell you what separates a lot of what we do. So most financial advisors, and I can say this because I've dealt with tens of thousands of financial advisors, most financial advisors spend about 50% of their time working with their clients or on their clients' things, right? So they're sitting down talking to a client face-to-face, they're building portfolios, they're working on their plans, whatever it is. But then they take the other 50% of the time and they're taking that to grow the practice, right? They're looking for new clients, doing things to bring new clients in. Dean and I are pretty fortunate. We have an amazing client base and we get referrals literally every day. So we spend virtually 0% of our time out there looking for new clients. They find us. They tend to come to us. And because of that other 50% of our time, we can now spend with our clients. So I am very big on education, and I've witnessed this, so I can use you as an example. But when you're talking to a client about doing a procedure, you're not going to educate them as much as right? When you're getting ready to do it, but you're doing it enough to make them feel comfortable and confident that what you're doing is the right thing for them to help them survive, right? And the more educated they are, the better they understand it, the more comfortable they're going to feel, right? I do the same thing. I spend a lot of time educating my clients. Here's what we're going to do. Here's why we're doing it. Here's how these things work. And ultimately showing them that that plan that I've created for them gives them a 95% probability of success, right? And showing them that if we just keep doing what we're doing here, you're going to be able to retire with the income stream that you want, live the lifestyle that you want, do all that kind of stuff. So they walk out of our door just feeling comfortable, safe, and confident, right? Not worried about their future. So then what happens is then they're out talking to a friend or family member or colleague, and they're like, oh man, I don't know what to do. Maybe I'll never, be able to retire, things like that. The first instinct for our client, if they care about them, is to say, wow, you need to go see Frank Ross. You need to go see him because he's going to make you feel that way, right? So it's really finding that advisor that you feel very confident and comfortable with that's going to do that. Now, Merrill Lynch, they and I'm not, they're a great firm, and they have products and services that some other firms don't have too, but we're completely independent. So we can do whatever we want to do for our clients. Everything that we do is based solely on their best interest.
Yeah. Frank, I want to dive deep into fees because if you've ever played with one of those predictive models that you can just Google as far as like how much money we'll have in retirement, if you change half a percentage point over 30 years, it's a shit ton of money. The fees that you pay in managing your money is basically taking some percentage points away. So if it compounds over time, it's hundreds of thousands, it's not millions of dollars, right? So what fees philosophy works for both so that everyone is a win-win, where a financial planner, makes a decent living, providing a lot of value for humans, but also you're not a victim of math and compounding by throwing 5% away. Like if you throw 5% away, you're kind of fucked, right? So because I think that's something that's not like very easy to grasp for most people. Like, oh, that 2% actually really fucks you as compared to 1%. That 1% is a lot of money. So what fee structures do you think align where everyone wins?
Yeah. So I think if you look at it, you really got to look at it like a receipt and say, okay, yes, okay, are we charging 1%? Let's say we do. What are we getting for that 1%? Right? What's each portion? So like I said earlier, if you want a portfolio built for you and like go to like a Schwab or something like that, and they build out a portfolio, they're going to charge you anywhere between 15 and 30 basis points.
Can you explain that in layman terms? What's a basis point?
Yeah. So 0.15% just to build a portfolio, right? A diversified portfolio. So that's the fee you're paying. And then, there's management fees, right? So if you buy that index fund or an ETF or a mutual fund, that mutual fund has a portfolio manager. They have to pay you statements and send prospectuses and all that stuff. And there's hidden fees inside of there too. And that's another thing, is that you got to make sure your fees are all disclosed, because not everybody discloses everything. So it's finding those line items on the receipt. And then you say, okay, but I have a portfolio built for me and I have that done. What else do I need? Right? Do I have a plan? Do I have somebody that's evaluating? Do I have tax planning? Do I have retirement planning? Do I have all these different things that are associated insurances, right? Because you might accumulate wealth, but then you have a long-term care issue in your 60s or 70s, and it deteriorates at all because you didn't have the insurance on top of it, right? And the protectionary aspect of it. All of those things different come into play, and you say, okay, is it worth that 1%? If it's not, go somewhere cheaper, right? And find that. I'm sure there's cheaper doctors out there, right? Are they better? I don't know, right? So they might be. They might be charging less of a fee, but it really comes into somebody where you don't want to get overcharged because there's no reason to pay that much. But if there's no fees, what are you getting as well?
But how do you become an educated consumer? Because I feel like it's very it's difficult to know what
How about
an
just
educated
ChatGPT it?
maybe.
Like, I'm looking at this product and they want to charge me 75 basis point. Is this too
Yeah.
much? And then I bet you that he'd go back and be like, Yeah, that's about the highest 1 percentile. You want to make sure it's something worth your money, like you're gonna make
Yeah,
all
but
that money back.
what is worth your money? That's an interesting question.
Well, I'll tell you this. I use a great example. There's a company called Dalbar, right? It's Dalbar, and they're a research firm. And they do research on a ton of different things, but some pretty simple things is they'll say, for example, the S&P 500 for the last 30 years has averaged 10%, let's say, for example, and bonds have averaged 6%, and real estate has averaged 8%, and so on and so forth, which anybody can find, right? Like that's pretty basic data. But they take all that data and then they do research on individual clients, right? Financial client might have a financial advisor, they might not have a financial advisor, but they do research and say, what did the average person get in their portfolio over that same time period? And what they found is the average investor, right? So if you're going to have, let's say you have a portfolio of 50% stocks, 50% bonds, and stocks average 10% and bonds average 5%, you should get 7.5, right? It doesn't take a math genius to figure that out, right? But the average investor over the last 30 years has actually only got about 2.4% on average, not even keeping pace with inflation, right? So Lucas, in your example, what did I pay for? Right? Why? Because they make the mistakes, right? They buy high and sell low. They jump in and out of the market. They try to time it at the wrong times. An example of that is that if you look at where the returns are generated in the markets, right? You look at over, what a bull market cycle and a bear market cycle is. So just really simple terms. I know people have heard those things and they don't understand what they mean. A bull market is when the market goes up more than 20%. So once it hits 20%, that's officially a bull market. And as it keep going up more and more and more, that's a bull market until it turns and goes down 20%. That's a bear market. Most returns are generated during the first couple months or at the end of the bear market and then the first months going into the bull market. And you know where most people are invested during that time period? In cash. They're sitting on the sidelines because of that recency bias. The market's going down. They're selling out as the market's going down. They've sold all out, right? When you look at it, in March 9th of 2009, right? That was just to end that story. That was the last day of the Great Recession, right? More people sold equity mutual funds than ever before on that day. More people should have been bought. That was the best buying opportunity in our lifetime, but more people sold that day than ever before, right? So they all sold out of stocks. The market went skyrocketing from that point. They were sitting on cash, right? Then the market goes up for 2-3 years, and they're like, man, I should have been invested. They take their money out of cash. They've lost 30%. They invest it again, and then what happens? Market goes down again, right? It's all those mistakes, the emotional mistakes that people make. And, Warren Buffett says it all the time, but the market is, to simplify it the most, the market's driven by greed and fear. And he says, be greedy when others are fearful and fearful when others are greedy. And during that same time, he took out a whole page article in the Wall Street Journal and talked about how his wealth, right? So not Berkshire Hathaway that he runs, but his own personal wealth at that point was 100% invested in U.S. Treasury bonds. And he said, but within the next year, 100% of his wealth was going to be invested in U.S. stocks. And everybody thought he was crazy. And it was the right thing to do.
I've never understood how those guys do these massive bets. I find it amazing.
They take emotion. They take emotion out of it. And there's another interesting story about him too. He tells it quite a bit, but it was like in April of 2000, he had taken his grandkids to like Dairy Queen or something like that to get some ice cream. And he was at the counter and the kid behind the counter was talking, oh, Mr. Buffett, you should buy this .com stock and this .com stock. And he kind of nodded his head and listened to him. And he was like, okay, thanks for the advice. And went back to his table and finished his ice cream. And then he drove home and he sold all of his .com stocks. Because it's like, man, if that guy's telling me what to do, I'm out.
Frank, where do you see, what's the vision for Pentangle? Where are the next 10 years for this company? Where do you guys see moving, in what direction?
So we've built it the right way, and we keep bringing in more and more clients and seeing that growth. We're definitely looking to build out our practice a little bit. We actually have one advisor that's she's originally from Peru, and she moved here years ago, with her, like years and years ago. I mean, and she's actually getting licensed back in the United States now. So she's going to be a Spanish speaking employee for us because it's a big market that we don't have. I don't speak any Spanish. So we're bringing her in. We actually have our own insurance agency in the practice as well. And we're getting a couple of those people licensed too, so they can do some more investments. And, ultimately, I'm not getting any younger, right? I'm going to be 50 years old here in a little bit. My business partner, Dean's 53. And we're going to need to, we want this thing to live forever, right? This is something, and I think, when people have that envisionment, it's not something that's going to die with us. We want this to kind of live on and be able to retire and see that thing keep continuing to grow, and bringing more people in as well into our practice. We have 4 staff members right now, and growing that too. But it's really the good thing about it is there's no cap. It's not like, oh, we can only, manage, like right now we manage, close to $125 million or so. There's no cap on that. We could take that to $1 billion if we wanted to. And right now, and technically Dean started over, with his practice in the end of 2022. We're at the top 9% of LPL advisors in the country, right? And we want to be in that top 5%. So we're looking to grow still. Definitely looking for new clients to bring those into our practice, and again, doing it the right way, right? So I'm sure you guys are like this too, where you'll have a patient walk in the door, a potential patient walk in the door, and you're like, wow, I don't want to touch this person at all. Same thing. And there's other people that come into our practice and say, hey, Frank, I want you to buy Bitcoin, and I want you to buy, day trade these stocks. That's not going to happen with us. We don't do that. So we're going to turn that client away because we don't offer what they're looking for, and we're not going to be the best person for them as well. So, we definitely turn put those people away. But the people that come, like the people that are making a significant amount of wealth or have a significant amount of wealth, they're making a great income stream and say, you know what, I want to retire. And I don't want to wait, because and think about this, right? You were talking about it earlier. People are making $500,000 or $600,000, $700,000 at the end of your career, right? When most people think about retirement, they think about Social Security. What's the max Social Security you could get right now? It's $4,000 a month, and that's if you retire at 66 or 67 years old. The max is $4,000 a month. It's not replacing your income. And that's if it's there in 20 or 30 years, right? So how are you going to replace that $20,000 or $30,000 a month you've been making when you're not getting paid anymore? And they say, you know what? I want to be able to do that without worry, right? I want to be able to do that and go on my vacations and relax and not have to worry about where that money is going to come from. Then you come and see us. We can help you with that.
Frank, one last question before we let you go. Do you own Bitcoin? And if you do you have it in a cold wallet or a hard wallet?
So I don't actually own the coin itself. I own IBIT. It's it's a safer way for me to do it. I'm not the most technically advanced person in the world. So owning that wallet, doing that things, that's beyond my realm of, where my knowledge is. So I do it that way. I'll let you know, like with our clients, that comes up from time to time, and some clients that they definitely want that. LPL limits the amount you can have in a portfolio. So if you came in and say, I want, like you walk in my door and say, I want 100% of my portfolio.
You want to go YOLO?
Yeah. They're not going to let me do that.
You want to
right?
YOLO it out?
Yeah. So,
laser eyes?
Yeah.
You don't have a meme, like you never had the laser eyes? You did.
Cold storage, 100% all the time.
Love that.
That's how you do it.
Let's go.
Yeah, you don't want your money sitting. It's like, what's funny about this whole thing is I think about it, and I open my Chase bank account, and I look at my bank account, and I'm like, that could go away tomorrow.
Yeah, 100%.
Like it's sitting in somebody's database.
Yeah.
And it's a matter of Russian intelligence just hacking and going like, let's take all this guy's $5,000 that he's made all his life and go.
You're like girl bossing so hard that Putin wants to take you out.
Yeah, exactly. I don't know, man. Well, listen, for all you folks out there, if you haven't thought about it, think about it. If you've been thinking about it, fucking do it. It's worth your time. There's people that know what to do. better than you. Although I will say, I always push back on, and I would give this. Here's my advice to you, Frank, is here's my advice that you're not asking for, but here it is.
May I
Because
give you
this
some
is-
feedback?
Yeah, because I'll tell you why. Because you need to, you said doctors aren't necessarily your primary clients, but maybe you'll get a couple of them after the show. But here's the deal. We have been talked down by administration at the hospital for years, making it sound like we can't fucking add or subtract. Like we are so smart at surgery and it's so complex. You guys don't understand money. Well, fuck you. And fuck your administration, thinking that I can't sit down and look at an Excel spreadsheet. I may not understand what 75 basis point is, but if you tell me, dude, it's 0.75, I'm like, okay, I know what that means. Right? Sometimes it's just the lingo. It's being able to have somebody to level with you and talk to me like I'm a smart motherfucker. Maybe talk to me maybe like I'm 6 years old. That's fine. But doctors are also smart people and should have the capacity to understand basic economics and finances. Now, not saying that substitutes having an expert matter opinion person that could say, here's how we're going to do it. But you could be involved in that. You can level with me. You can tell me that. And so I think that's, physicians are disenchanted with finances and money and economics because we've been told that we're dumb at it. We've been taught that we can't do it. Nobody tells us in medical school how to manage assets. Nobody tells us how to protect wealth. Nobody tells us what the S&P is. Nobody tells us shit because we're doctors and we're so good at what we do. You should just give all our money to us and let us manage with it. That's dumb. So physicians, get into your driver's seat, manage your money with somebody like Frank that can give you the advice. What are your thoughts, Frank, there?
And read.
No, you're 100%. And that's why we educate our clients to the way we do, right? Because it's not just, it's doctors, it's refinery workers, it's lawyers, it's everybody. Yeah, it's my job, but it's not my job to know your job either, right? So I think the best people that we work with are well-trained professionals, right? These refinery guys, people think, oh, they go to work in coveralls, and no, they're experts at what they do.
Yeah.
Right. Like I have a friend that his son just graduated. He's a lineman at Centerpoint, and he was telling me all this stuff. I'm like, oh my God, if the electricity went out, I have no idea what to do. Right. But this kid does. He can find the pole, climb it, and fix it so that we have electricity. Right. He's an expert at what he does, and he gets paid very, very well for that. But he doesn't know my job. It's my job to come in and then say, hey, I'm your financial doctor. I'm going to make sure that your financial health is on point and survives as long as you do. Right. It's kind of a very similar thing. So it's really finding that person that's going to educate you and make you feel confident and comfortable with that. And that's truly what we do, is make sure that you do that.
Well, awesome. Frank, I'm gonna call you the financial
doctor,
analyst for the Life of Flow podcast.
You're a financial correspondent officially.
Exactly. And so when
there you go, I would be more than happy to be your financial correspondent.
Dude, in the future, when we have questions or fun stuff, or maybe something crazy's happening, or Trump goes on some wild shit and the whole market slumps, we'll have you back on the show so you can give us some opinions and help us through understanding what we can do, what we shouldn't do. But I appreciate your time, brother. You're awesome, and obviously I'll see you at anytime soon in the neighborhood. But thank you for being here, and I hope that those out there that want a little bit more guidance, look at the show notes. You'll be able to find all the information on how to get in touch with these guys and have them give you a little bit of financial compass, if you may. All right, you good?
Thank you, Frank.
Thank you again for having me. I really, really do appreciate it.
God bless you, brother.
Awesome.
Take care.
You.
Bye.